Hello and welcome to your Global Markets Technical Outlook for the end of quarter 2 of 2022. Normal disclaimers apply as we get into this time's pithy quote from Warren Buffett, who can always be relied on such quotes, who says the stock market is a device for transferring money from the impatient to the patient. Well worth bearing in mind as we're in this sell-off phase, whether you're either holding through it or you are planning to try and get back in at some point. It's always worth being a little bit patient through these times just to optimize your outcomes. Heading into the US stock market as we do, and kicking off with the monthly chart, and you can see that collapse of the market recently falling back through that 4,000 level, really starting to look like a bull trap above that 4,000 level there, and now edging back into this kind of megaphone pattern that's been in place since, really since the end of the financial crisis lows. The next level of meaning support is probably in that sort of mid 3,000 area, where a lot of people happen to think that's really fair value for this market, given the earnings of the underlying stocks at present. So I wouldn't be surprised to see us just edge back down towards there, given the momentum of this sell-off that we've seen. On the weekly chart, again, we can see that just a hint of a head and shoulders there as it rolled over that top, and now in that steep decline, as I said, and heading looking for that sort of mid 3,000 level. On the Ichimoku chart, we are through the cloud convincingly with price, and you can see the Chiku span or lagging line, this green line here, just edging through the cloud very recently indeed. And so that means that we're now confirmed bear territory, and the cloud now becomes overhead resistance around about that 4,300 to 4,500 area should we get a bounce in this market. Switching to the market fundamentals now, and you can see that the market breadth is really in dire straits at the moment. Less than a third of S&P 500 stocks are bullish at the moment, so that's a very low number. You can see this has actually even been lower recently, down around that sort of 12 or so area. That's often a area where you will see a meaningful bounce in the market. So whether this is about to eventuate or not, we'll have to wait and see, or whether this sells off again. But very low on the bullish percent index at the moment. Same on the stocks above their 200-day moving average. It's even lower, less than a fifth of stocks above their 200-day moving average at the moment. So that's getting towards those lows that we saw back in March of 2020. One ratio that a lot of professional fund managers are keen to keep an eye on is the ratio of discretionary to staples, and you can see here the steep decline that it's been in as well, indicating that stocks or companies that sell staples are doing far better than discretionary items at the moment, and that's just indicating that basically cost of living pressure, inflationary pressures and so on, people tightening their belt. They're not going out and buying new cars at the moment. They're more interested in putting food on the table. This is often a leading indicator, and so if we start to see this turn around, that might be the first sign of green shoots for the market. Same for the ratio of the semiconductors to the S&P 500. You can see that how this kind of flattened out and began to roll over, probably a little bit ahead of the market, and just tracking the market lower. And once again, the semiconductors do tend to be a bit of a leading indicator, so we're looking for this to stabilize before we'll get any meaningful move up in the market. The advanced decline line, you can see that we're now in the kind of longest period, going back 2 or 3 years, that we've seen where the line has been below its 21-day moving average in this instance, but just generally a fairly deep decline, and you can see again that rolled over before the market actually rolled over as well. So another leading indicator to look for. If we can get this back above its moving average, that will be a good sign for the market. Looking at the big 3 major indexes in the US and their relative performance, and you can see the NASDAQ is really the sort of poor man, down almost 30% for the year to date. That's the sort of tech heavy stock. Those stocks are very sensitive to rise in interest rates, which we've been seeing recently, of course, and so that's weighing heavily on that. A lot of those big tech stocks are obviously a big part of the S&P 500 as well, so that's been dragging that down, and the small caps also selling off, which hasn't been helping overall. So down around 20 to 23% for the S&P and the Russell, and about 29 for the Nasdaq so far this year. And this could be one of the reasons that we're seeing that. The yield curve now is really starting to flatten out, and you can see just slightly inverted in a couple of spots along the curve itself. So that's indicating that, you know, we're seeing those rising interest rates now, and that does tend to have an effect of making the risk calculation of investors change between stocks and bonds, and money will flow out of the more risky assets and in towards those so-called more safer assets such as bonds. And we can see here how that ratio has really declined. This is the 10-year to the 2-year, so just looking at one part of that yield curve, and you can see it's now inverted. It's gone below zero, so that indicates an inversion of that part of the curve. And again, this has been a leading indicator. This actually topped out back in March of last year, and obviously the market didn't sell off until the early part of this year. So the yield curve way ahead of market the market action itself. The 3-month versus the 10-year part of that yield curve tends to be a little bit more indicative of, especially of things like recessions, and you can see they're coming close to the 10-year in black and red here. I beg your pardon, the 10-year in the blue here, and the 3-month in the black and red. And you can see how the 3-month, which is the very short end of the curve, coming up to meet. They haven't quite crossed yet, so we haven't got that inversion, but it's coming close. And if we look at what's happened historically when we've seen that, you can see that these grey areas indicate the recessionary periods, and preceding almost every one, we've had an inversion of that 3 to 10-year ratio. It's heading down that way. Might even be a little bit lower than where this chart has it. But if that nicks below zero, then that increases the probability that we'll see a recession in the next 12 to 18 months. Here's one reason to be a little bit more hopeful, at least in the short term. The put-call ratio now, we were looking at this area last quarter as being quite bearish, because this indicates the market is getting a bit frothy, and as we've seen, that the market has sold off since that time. But now the ratio has kind of gone the other way. In other words, there's many more people demanding puts than calls, and that has led to an extreme, has just hitting that sort of bearish extreme. So we could be close to some sort of near-term bounce, in some meaningful bounce in this market. Now we've crossed over that line. You can see here back when we had the COVID crash how elevated this ratio got, and that was really a massive buy signal. Not quite as clear cut this time, and obviously this could push higher into that area, but it's starting to look a little bit more hopeful than it has been. Another interesting thing is that although the sell-off has been fairly steep, we haven't seen the volatility going bananas like we did back in March 2020, and also in previous large bear markets such as 2008. It's really been quite muted on the volatility front, and you can see here it's just in this kind of middle, what I've called the elevated risk zone, in that mid-20s area. And that's another reason to maybe be a little bit more hopeful that this thing isn't going to start collapsing. Of course it could still do that from here, but this indicates that there's not a lot of panic in the air. There's not a lot of people demanding insurance for their portfolios, so a lowish VIX probably favors the upside a little bit more than the downside. That's not to say we can't go down and break the lows that we've made, but for now it's fairly muted on the VIX front. So let's get our crystal ball out and have a little bit of a gaze and see where we can see where we are heading from here. Firstly, I guess we'll take the bearish case, and if we look back at the previous bear markets in the last century or so, the median duration is around about 12 months. Now, the current one has lasted about 6 months. It started really at the start of 2022. So if this is a quote-unquote average bear market, then we could be looking at another 6 months before this thing turns around and starts making gains again. Of course, you can see the standard deviation is quite large, so that the 12 months is a long-term average. It doesn't mean it could end. It doesn't have to match that exactly, but that's something to think about. If we are still heading into that more bear territory, we could look at an analogy such as the 2002 bear market. That was the tech wreck, or the internet bust bear market that we had. The orange line here showing us 2022, and the purple line here showing us 2002. And you can see that at least that bear market still had a fair way to go, and it did have that sort of capitulation low before it bounced and started. That was the long run. For those of you with long memories, it was the start of the Iraq War back then in 2003, and boom, off it went to the upside all the way into the top of 2007. So this is one scenario. It doesn't necessarily mean it has to follow this pattern exactly, but we don't seem to have that capitulation low in yet that we got back here. So that might be something to keep an eye on. If we do see that massive capitulation and a serious bounce, that might be the start of some green shoots. So how bad has it been? Well, if we look at the current year, now we're only halfway through the year, so this is not a full year yet. But if we look at the annual returns of past full years, you can see we're at one of the worst sell-offs that we've ever had. So that does make you think, surely, given that. Does this really compare to World War I or the Great Depression? Probably not, which indicates that we may see some retracement of this market to the upside before the year is done, to bring this into something that's a little bit more reasonable in terms of the total return for the year. But if we just look at the first half of years, then we are really, we have had a terrible first half of the year. In fact, it's the fourth worst in the last 95 years. So it's an extreme left tail. And again, that does make you wonder whether we might get some reversion towards the mean in the second half of the year. And if we look at the stats, there's some hope to back that up. If we look at the performance of the second half of the year, if the first half is in the worst 5, as we are, well, we could be looking at something like a 23% gain in the second half of the year. And every time that's happened, it's ended up in a profitable outcome 100% of the time. Obviously, it's a small sample size. You have to be aware of that, but it is way on that extreme of that left tail. And the next 12 months, if we look at the next 12 months following that worst 5 of the first half of the year, well, we could be looking at something like a 40% bounce. Now, remember, these are averages, so it doesn't really bear any... it might not bear any reality to what actually eventuates, but it's something to think about. And 60% of the time, the next 12 months have been profitable when the first half has been in that worst 5. So there is hope that this, given that it has been a severe sell-off, then it's possible that we do get some bounce at least into the end of the year, if not over the following 12 months. Another reason to be slightly hopeful of that is that this is the Bank of America bull bear indicator. There's a bunch of it's a proprietary indicator, but they use a bunch of sentiment indicators, and you can see it's worse than it's ever been. Meaning that we could be reaching some point of exhaustion, and everybody who wants to sell is probably already sold, meaning that there will be there could be a vacuum, and we could see buyers entering the fray. On the seasonality, just to temper that bullish talk that we just had there, Don't forget that we are entering the so-called summer doldrums, or the northern summer doldrums at least, where the market just tends to go into sort of caretaker mode between now and September, October. So the current year to date of the S&P 500 has actually not been a very good analogy for the cycle itself. It's obviously been quite bearish, but it's hard to see that this is going to suddenly turn bullish right now, given the seasonality is not super bullish at the same time. Same on the mid-year presidential cycle, a midterm year presidential cycle. In this case, the year to date has actually been following the cycle quite nicely, and you can see that this actually doesn't bottom out till September, October time, as we come close to those midterm elections, which are in the last quarter of this year. So again, that's another reason to think that we may not be at an inflection point just yet, and we may have to wait another month or two to get there. And in fact, if we look at the midterm years, when it's the second year of a new Democratic president, which we have, we get this red line here, which doesn't bottom out till, in fact, late October, early November. So that does, again, that's another thing to think about when you're considering whether this market is about to turn around and move higher. It could actually be another few months, given the amount of seasonality that's working against it. If we kind of zoom out from the yearly seasonality and look at the decade cycle, it does indicate that we could possibly be reaching some nadir that does tend to happen in year two of decades, obviously 2022 being a year two. So we're bang in the middle of that now, which means, you know, they could be good times ahead. Now, of course, we have to remember that we've been in a raging bull market up until the start of this year, so we may not be ready to take off like this chart indicates, but it does indicate that the end of the sort of bearishness, if you like, of this cycle might be coming to an end. On Calvert's decade pressure cycle, again, this also indicating, you can see all the negative rate of change through here, and then as it turns more positive for the next 2 or 3 years following this period. Switching now to the Australian stock market, looking at the monthly chart, and again we can see that sort of bull trappish looking pattern here up the top. It broke the previous all-time highs, the 68.52, and then it blasted through that all-time high at 7,200, but it's now quite convincingly collapsed back through that level, and just sort of trying to hang on for dear life at this trend line here. So that will be interesting to see whether it does manage to consolidate around this area, maybe push a little bit higher, but it's not looking great for this chart here. On the weekly chart here, you can see the size of those candles as we've been getting those big weekly bars selling off. Again, back to this trend line here, just kind of last few weeks, just trying to consolidate here, but this could just be a dead cat bounce, and you know there could be a lot of shorts waiting just north of here to get set for the next leg lower. And the Ichimoku just confirming that we are now in confirmed bear territory. It's pushed through the cloud on the price. The lagging line just not quite through. It's bounced back into the cloud, so we'll give it the benefit of the doubt for now. But should we see another week or two of red candles, that will bring that Chiku span through, and we will be in bear territory. The cloud looking very skinny up there around about that 7,200 level, so that's your overhead resistance, and that could be where those second chance shorts are sitting waiting. Looking at the comparable indexes to us, we can see that we're kind of in a group with the Hang Seng and the Shanghai, doing marginally better than the S&P 500. Now this could be the boost that the commodities have been giving to the ASX 200 recently, but as we'll see in a moment, that's probably coming to an end quite soon. But down around 10 or 12% is very respectable when you consider the S&P down about 21 for the same time period. On the currencies, well, the US dollar index has just gone crazy. This is a wild chart for a large currency, not least the reserve currency of the world. Is starting to act like a cryptocurrency in the way that it's moving here. We did get something similar here when it broke out of this big long-term pattern here, so it could be that we're seeing the same thing. Obviously, it's got tailwind of rising interest rates in the US as well that's driving this a bit higher. And, you know, depending on whether you think the dog wags the tail or the tail wags the dogs, the commodities have been selling off again, as we'll see in a moment. They're all priced in US dollars. So that's another factor as well. But blasted right through from a technical basis, this 104 level. So it's pushed right out of this long-term range that it's been in. And it's, well, who knows? The sky the limit is the limit. I mean, it does starting to look very overbought at this area. I do think it will exhaust itself at some point. We'll get a pullback to that 104 level, and then we'll get some indication about whether it's above 104 to stay or whether it comes back into the pattern once again. Of course, the effect of that strong dollar is really hurting every other currency that it's crossed with. The Aussie dollar is getting hurt by that, and also hurt by the commodities rolling over, as we'll see in a moment. But it's now, it made one attempt at that 80-cent level and it didn't make it, and it's really just been sort of collapsing since then. It's now back through 70 cents, and, you know, who knows if the US dollar continues to move. Could we see it back at 60? Let's wait and find out. The euro is the biggest casualty of the strong dollar, of course. We were hopeful that we had a kind of long-term breakout from this pattern here. We were waiting for it to try and test this 123 level again, but it wasn't to be, and it's just been quite a waterfall decline, really. It's back through this 105 level, which is significant because that was support back here in the mid-20 teens. And yeah, it's not looking great for the dollar. Just dancing around parity there, as you can see, which we haven't seen for a very, very, very long time indeed. So that is now quite significant. And the Japanese yen, well, it's a similar story, really. It's just not had anything to write home about after it was consolidating in this symmetrical triangle. I guess we should have expected that the exit from the consolidation would be towards the long-term direction of the trend, which was obviously down from this period here, and down it goes again. So it's gone right through this, the old lows from 2015 and to the financial crisis, or just prior to the financial crisis, I beg your pardon. So again, that's a significant move in a very large currency like the Japanese yen. And well, Bitcoin has also been suffering for similar reasons. The strength of the US dollar is obviously an effect on this, but also the Federal Reserve turning off the fire hose of money that's been flowing into the market since COVID times. That's now become a tightening, and, you know, a lot of the money that was flowing into Bitcoin was really sort of excess assets that were or excess cash that was coming into the market via the Fed. So the party's over for Bitcoin for now, down 70%. So, you know, investors with strong stomachs only need apply to trade this market. Difficult to see where it goes from here. There's basically no pattern. It's like catching a falling knife at the moment. It's obviously trying to stabilize around about that 20k mark, which is off the edge of this chart in terms of where it was as resistance. It's now trying to become support. It's obviously quite oversold. We may get a bounce, but I wouldn't be surprised if we see it even lower. Finishing off on the commodities, and as indicated, we are seeing them starting to sell off. Crude oil had an attempt at that 112 level, well, 3 attempts at that 112 level, but it wasn't to be, and it's now started to pull back. So oil is a big loser in when, you know, when there's a contraction in the economy, effectively. So this is the inflation expectation in orange here, and the oil, as you can see, sort of has followed that up and will probably likely follow it down. There's the interest rates are going up. That's the expectation is that will bring inflation down, but there's also the risk that could cause a recession to ensue, and when there's a recession, that contracts production, and there's less demand for oil, which also makes the price of oil fall. And of course, oil is a massive input into many things, not least of all the food industry and agriculture. And that fall in the price of oil is having a positive, if you want to call it that, effect on the price of wheat, which is now falling again. So we may start to see food prices falling, especially as the inflation expectation is now to be lower out into the future as well. Gold also just didn't quite make it. It was a nice double top actually on that 1925 area, but it's basically a second bull trap. It's now back inside the pattern. I mean, if you want to be fair to it, it's really just in a range between about 1700 and 2100. So we'll see where it goes from here, but it's looking a little bit bearish at the moment for gold. And copper, well, wow, that's been a big sell-off. We're seeing a lot of sell-off in the industrial metals across the board. In fact, again, because of that expectation that we're going to see a contraction, less demand is in the market for these production commodities and construction commodities. So copper is often a bit of a bellwether for the economy as a whole. So bearish copper is not a great sign for the economy as a whole, and probably leans more towards that probability of a recession at some point in the next year or two. And lastly, iron ore, which has been in the news a lot because it can't catch a bid at the moment. I mean, we should have expected after this massive sell-off last year that if we did get a bounce, that it wouldn't be straight back to old highs again. So we are seeing that sort of ABC type correction playing out at the moment. And will we get back to 90? Well, that's highly probable. I'd say it's more likely we'll get back to 90 than go to 220 at the moment. So we'll see what happens when it gets there, but obviously iron ore is a big input material, and if we do get some contraction in the global economy, then that's going to hurt the demand for iron ore overall. So just to round that up, the US stock market, we're seeing that angry bear unleashed as he wakes up with a sore head, and that's in a high momentum sell-off at the moment. The Aussie index is coming off that bull trap scenario, and that could see a little bit more downside to come for the Aussie index. And the US dollar is just rocketing ahead, and that's really just devastating all the cross currencies everywhere else. And the commodities also selling off, one because of that rising US dollar, and two because of the expectations of contraction coming in the global economy. Thanks very much for your time. If you are interested in receiving this more regularly and you haven't signed up already, then please head to the website, drop your email address in, and I will get it to you, or you can catch it on YouTube. And if you want to get in touch with me, that's my address there. With that, I wish you good luck, good trading, and bye for now.